Well, good evening, everybody. This is Ron Wheeler, Options Income Coach here at VectorVest with tonight's special presentation, Printing Money from Weekly Income Trades. And in tonight's presentation, I'm going to show you how using weekly SPX options, how we can create a bulletproof system in as little as 15 minutes per day. A lot of people come to me when they want to create income and they say simply this: it's really hard to find a trade. It takes a ton of time. I got to go through thousands of stocks and I really just can't narrow it down quickly. What I want to introduce to you tonight is the idea of keeping it simple. When we do our income trades, we trade along the idea of a 5-step process. We look for market direction. If the market is trending up, and we use the VectorVest market timing graph for this, we go bullish. If the market timing graph is trending bearish, we go bearish. That alone will bring us down to an easier selection process. If the market's bullish, we only find stocks that are bullish. Bearish, we find stocks that are bearish. But that still leaves us with thousands of stocks to trade. And that's before we even get into option selection and trade setup and the management and any tools for efficiency. What I want to introduce to you again tonight is something very simple that I have been trading for over a decade, and I've been trading derivatives of the S&P 500 now for over 20 years. So again, the whole purpose tonight, the bulletproof system, is to keep it very, very simple. And how do we keep it simple? We can keep it simple by simply using the S&P 500. We can use S&P 500 options as one of our main drivers of our income system. Now, the S&P 500 options, they come in a couple different flavors, if you will. There are index options and there are ETFs. Now, I personally prefer trading the index options. Index options have a cash value. There's no exercisable stock, whereas an ETF like the SPY is a stock. There's benefits of owning the SPY if you actually own the stock. You get dividends. There's things that you can do with that. But they also, when you trade SPY options, you can be exercised, which I don't like to have that threat over me. Now, SPX is a large option of the S&P 500, and the XSP is a mini version of that. And I'll explain a little bit about that here in just a few seconds. But index options like the SPX, they're cash-based and cash-settled. Never any early expiration and no assignment risk. They're called European-style options. Now, I took this next page right from the Chicago Board of Options, right from their website, and they talk a little bit about the benefits of SPX options. I mentioned this: cash settlement, European exercise. There's no early assignment risk. There's a large notational size. Trading the SPX options is worth $100 times the S&P. The S&P is around 3,200 right now. 3,200 times $100. Okay, so it's a very large contract. The XSP uses a $10 multiplier. I'll skip the covered margin treatment. They also have extended hours, which are nice. Contract flexibility. They have weekly options, which are very, very heavily traded. There's a lot of liquidity there. You could trade options that expire on a Friday, a Wednesday, a Monday. We typically only use the Friday options. Now, this one I'll tread a little bit lightly into because, as always, consult your tax advisor for this. But one of the reasons that I like trading SPX options is that 60-40 tax treatment. For those of you with a regular trading account, not trading in an IRA or a Roth or something like that, there are benefits of trading index options. They are treated like a futures contract. A futures contract is taxed a little bit different. So again, I took this little snippet for you from the CBOE. If you just simply Google SPX tax advantages, you can find a plethora of information, but it is definitely something that you would want to research because there is potential great tax advantages for trading the SPX or the XSP options. Ironically, the SPY is not treated like this. So that's another reason why I tend to trade the cash indexes. Now, I want to bring in some ideas that we talked about in last strategy of the week. We talked about creating an income by being an option seller. I want to go back to that because that's the primary driver of how we're going to create this bulletproof system in 15 minutes a day. We're going to be selling low probability options. Now, if you remember from last week, I talked about if you buy a stock or if you buy a call or buy a put, ultimately you have a 50-50 chance of success. Okay? The stock or the S&P can go up or it can go down. Now, what we are going to do to design this system, we are going to give it a lot of probability. Now, last week I talked about a minimum of 60, sometimes even 70. The S&P, we are actually going to trade with 80% probability. So if you are bullish on the market, this is the kind of range that you would have. Taking example of before the market closes today, the S&P was trading at 32.30. If we were looking to place a bullish put spread, our strike would be down basically around 3,100. It gives us a lot of room to be wrong. Now, on the flip side, if you are bearish, same idea. You're not going to get quite as much room as you will on a put spread, but even so, the market's trading at about 32.32 to get that 80% probability that we're looking for. And I'll talk a little bit about that later as we kind of build a trade together. We're going to be in that 33.25 area. Still, even so, about 100 plus points of buffer to be wrong. Okay? Now, over the last 4 years, I've been doing this system for a while now. I've been working here at VectorVest since 2016, and actually 2015, and I started introducing this to our clients back then. Over the last 4 years, the system has had better than an average 80% success rate, and I've been doing this even longer. Now, I want to continue on the idea of essentially building a trade with you. We talked about last week controlling the risk, because the biggest enemy of an income trader is to take losses that far exceed the average gain. We don't want to get into a situation where we're trying to make $100 and risking $10,000 to do it. If you ever heard the expression trying to pick up pennies off a railroad track, that's something that's very, very popular for people to talk about with option selling. That's not what we're doing here. Okay. Now, to talk about this, I don't want that one bad trade wiping out a bunch of winner. That ultimately is my enemy here. So I want to show you a graph essentially of the S&P 500 over the last 3 years. This starts in 2016, and you can see in 2016, we had a decent trend in 2016, a little bit of area of volatility here in May and July. A little bit of a drawdown here in November and January, and then it was smooth sailing. 2017 was probably the easiest trading year ever because the market was so smooth. There was not a lot of volatility. There was not a lot of drawdown. It was just up, up, up without any pullbacks whatsoever for the most part. So 2017, very simple. 2018, I think we can all agree was a year that we could probably forget, right? 2019 was a pretty decent year. We had kind of a bracket year, right? The beginning of 2019 was great. The middle was kind of subpar because of all the volatility. And then the last few months of the year was just nothing but beauty. Okay. And hopefully this 2020 doesn't start out like it did back in 2018 back here. But I want to show you testing results of this. And I'm going to explain a couple different things as I go through each scenario with you. I want to first show you 2016. 2016 was probably the second easiest year to trade this system. So I want to point out a couple different things. Number one, what I do with my clients, we take these trades every Monday. Now, if you take it Tuesday or Wednesday or Thursday, historically, it's not going to throw off the results because it's all going to average itself out. What you are seeing is the results of doing an S&P index trade on a Monday at 10 a.m., holding that trade till it's profitable, and then waiting till the following Monday to place another one. So if I take a trade on Monday, it gets profitable on Thursday, I do nothing, and then the following Monday I place my next trade. If on Monday I place the trade, and that trade happens to take 10 days, well, I only have one trade over the period of 2 weeks. It's a very simple system. You're not going to get bogged down in it. So in 2016, the number of trades that we took was 31. So you're not taking trades, it's not day trading, right? Out of that, we had 27 winners and we had 3 losers. It's a pretty good year. Now, the one thing I want you to focus on here is I want you to focus on the average winner, which is $150 a contract. Now, if this is trading one contract, it's $150. If you were trading 10 contracts, it's $1,500 a trade. The average loser is about $300. So the whole idea of one bad trade and wiping out a bunch of winners, as you can see, that's not exactly what's happening here. Is the risk more than the reward? Absolutely. That's the hallmark, by the way, of being an income trader, a credit trader. You are sacrificing that I want to make $2 and risk 1 with a 50-50 chance to I want to make 1 and risk 2, but now I have an 80% chance. That's the idea of an income trader. And you can see, very, very nice, smooth. Now, I did not put in here 2017. 2017 was very, very similar to 2016. And you see it on the graph. 2017 was easy. 2018 was not so easy. And I want to show you guys how this all works. So in 2018, here was our results. Again, we had 32 trades. The average gain in a very volatile year was 151, and the average loss was 311. So even with the volatility, our average gain to loss was the same. Now, what you see here is in 2018, we had 32 total trades again, 23 winners, and only 9 losers. So we had a little bit more losers last year. Now, if you're wondering how that works out from a rate of return perspective, if you were to trade one contract of the S&P and use our recommended requirements of account size, to trade one contract of the S&P, I would recommend that you have at least I'm going to say $7,000 capital for each contract. So at $7,000, if you would have traded one contract in 2018, you would have walked away making about $700 or $800. Okay, you'd have made about 10%. Now, taking that back to 2016, if you would have had a $7,000 account, you'd have made $3,100. Now, I get this question a lot. Okay, Ron, that's one contract. So what I did is I also ran 2019, and we do these trades. I ran it through the system to give me the breakdown. So in 2019, the year that we just ended, this is what the system ultimately looked like. Now, what I did is I bumped this up to 10 contracts. So how much would you have to have for 10 contracts? $70,000 to actually use the right risk. Well, with that, you'd have made about $20,000. It's a pretty good return, okay? The 27 winners, 8 losers. We had a couple more losers last year. You can see we had a little bit of volatility towards the middle of the year, but overall, still a pretty good year with lots of movement. And here's the cool part. The average gain still right around 150 or on 10 contracts, 1,500. The average loss last year actually went down a little bit to about $2.40 or $240 a contract. Okay, that's the beauty. And you can see the average number of days in trade. A winning trade had 5 days on average, and a losing had about 13. So you can see the average trade's about 7 to 10 days. And again, you're talking over 3 years, you're talking 35 trades, 32, 31. And again, in 2017, very similar results to 2016, we had 32 trades. Okay. Now, to do this, you have to manage these trades properly. And that's the big thing. The S&P strategy, I will tell you right out, is not necessarily for everybody. It's not day trading, but it does require you want to have a broker that has alerts that can alert you to changes in the market. You might want to take a look at the market every day, not for hours, just to look at the S&P price to see if it's something that you might have to mitigate. You will know ahead of time if you have to adjust and manage this trade. It's not a simple in with profits out. There is a management strategy that we have to employ here, but it works well. Now, we talked last week about not being greedy, taking profits at 50%. We're going to do the same thing for these S&P 500 trades. Now, when a credit spread or these S&P trades go against you, you have to have ahead of time a plan in place and be prepared to act. Okay, so let me show you a little bit of how this works. I want to show you an example of a trade last year that didn't quite work out very well. Now, this was a trade that I placed, and it was back on, it was back on July 29th. Now, on July 29th, the market timing, as I go through my slides, July 29th, the market timing was in an up, a DEW up, like we use here in VectorVest. Okay, so that tells me to place a bullish trade. So I did. I placed a bullish trade. Now, I'll give you kind of the idea here using my trade log. On July 29th, I did a 29.25, 29.05 put spread. So, what does that ultimately mean? At 29.25, I was trading that, oops, I went the wrong way there, pardon me. I was essentially trading that right down here, okay, right there. I gave myself a lot of room to be wrong on that trade. Well, guess what? I think we all know what happened, right? After that day, the market shot down, and it was, not exactly the best looking trade in the world. Now, let me give you an idea of how I actually manage this position, okay? I mentioned to you earlier, I did a 29.25, all right? Right about here. Now, here's how this works. As the market, if the market comes down, all right? So we can see next day, the market shoots down. When the market gets about halfway between where I enter the trade and my short option, which in this case was 29.25, I essentially add a call spread to the trade. That way, as the market goes down, I collect premium from this side. That offsets my losses. I do that 2 times. So as the market goes down, I can offset the loss. I exit my initial trade when it hits the 29.25 mark, and then I'm going to be collecting premiums on the way down from this trade. So just to show you, again, a trade log of how that trade worked. And again, I don't want to confuse or scare anybody. This is probably the worst case scenario that you would ever see, where it happens like this. On July 29th, I placed my trade. At 2:30 on August 1st, I placed my call spread. The very, very next day, I took profits on my call spread, and I placed a second call spread. Hey, on August 2nd at 10:15, the market fell down, and I exited my put spread, and then 3 days later, I exited my call spread. So just to give you an idea how that happened again, okay? Market starts selling off. I sell a call spread. By the time it gets down to here, this trade is a loser. My call spread is a winner. As the trade sells off even more, my second call spread is a winner. Okay? That is how about 95% of your mitigations work. It's that simple. It's something that you can honestly do on your mobile app, on your phone, in 15 minutes a day. It's really that simple. Now, I realize you're looking at it and saying, well, I don't know about that, but trust me, it's a bulletproof, all written down ahead of time plan. Okay? That's how it ultimately works. Okay? So that's the idea behind this. Now, I wanted to show you, again, an idea of what could happen if the trade goes against you. A good way to kind of mitigate and understand how the management works. So what I want to do with you in the last few seconds here is, let's actually go through and let's do a trade. Let's set up a trade right now based on how this would work. And again, I would urge you, don't do this trade because there's still a system that has to be applied to this, and you have to learn the system a little bit more in detail. But I want to show you the idea of how simple it can be. All I do is I look at my market timing graph. Right now, with the DPO below 0, below the weighted moving average, we are in a DEW down. Okay? When we are in a DEW down, I generally sell a call spread. How do I do it? I would go into my options platform. I happen to use Options Pro. I would open up an options chain. I go out to a 21 to 25 day option. Right now, the February 21st is 21 out. And then what I do is I look for an option, in this case a call, that has a less than 20% chance to finish in the money. And you can basically see where I'm going to be. And I do this a little bit different, not off the ITM. You can actually see I'm going to go down to about right here at about an 18 delta. And this is ultimately the trade that I would be setting up. I would be selling a 33.20 and buying a 33.40. And you can kind of see how that trade gives me quite a bit of room to work with. And you could say, hey, Ron, the market's very volatile right now. Is that really a lot of room? Historically, yes, it is. Okay? Historically, yes, it is. This trade altogether has about a maximum profit of about 220. My risk without any mitigation at the short strike is about 450. So it's not a bad trade from a risk reward perspective, even without mitigation. So that's ultimately the idea of what we do. Now, if we thought that the market was bullish, which it's, not right now, we would flip that around and essentially do a put spread. A put spread doing the same idea. I look for a delta typically below 20. I would be selling something around 30.95. And I usually would buy a 20-point spread, and it would look very, very similar to this. So this is the trade that gives you those results that I showed you. Okay, this is the trade. Now, if you take a look here, lots of room to play on the put side, down to 30.94. This is the idea behind this trade. Okay, now, if this is something that interests you, this is what we can do. If you want my help to implement this strategy that's worked so well over the past few years here, I am going to be launching next week a new options paycheck course, which covers the S&P, but it also covers how to do this on stocks in bullish markets and bearish markets, as you can see in modules 2 and 3, how to select trades, also indexes in module 4, setting up the trade, managing it properly, showing you the mitigation and repair concepts that we can use, and also talking a little bit about the execution. I also, of course, have some bonuses, the 7 live mastery support sessions we talked about. These are ways of us getting together in a live group, and we can talk about the things we go through with each module, making sure you're ready to advance to the next module. We also have a private Facebook community where we can discuss the trading ideas. We can discuss the current course. It's a way that you can get together with your fellow attendees and work through these together. It's also a way for my staff and I to get a hold of you and talk to you in different hours. That's also included in the options paycheck. I'll give you the access to our members group coaching. We do S&P classes on Monday morning. We do stock trading classes on Tuesday to kind of implement these strategies. This is the one I showed you. I said I do these with my clients every Monday. That's where I do these S&P trades, and we follow them every week. And then I'll also give you access to that Options Pro software and VectorVest if you do not have it. As part of the options paycheck, you'll get access to that for 7 weeks as the live course starts. And we also, I want to talk about a special S&P bonus course. Now, at the end of the options paycheck, I have a special separate presentation that walks you through this strategy on holding your hand. How to use market timing, how to select the option right, how to mitigate the trade when it goes against you. It's a separate course that uses the S&P only, and it has its own rules, its own check sheets, and it's just a separate thing that we're going to be throwing in as a bonus to this. Okay? If it's something you're interested in, again, kind of give you an idea, even if you've never had success with options before, you can do this. That entire package, if it's something you're interested in, it's $9.95. Go to optionspaycheck.com. We will be closing registration, and that $9.95 price does end. If you go to Options Paycheck, the $9.95 price does end in 3 days and 10 hours. So you do have a limited amount of time for that $9.95. After that, the course will go up to $19.95, and you'd have to pay that rate. So you do have a couple more days to take advantage of that $9.95, including that S&P bonus. All right, well, I'll leave you here tonight with that. The S&P, again, is one of the primary drivers of my yearly income, and it really has been for the last 20 years, whether it was S&P futures back in my early days, to the SPX options in the last decade, to how we trade this today. So I hope that gave you an idea of how you can simplify things and really, truly create a 15-minute a day, even in some cases only 15 minutes a week, bulletproof trading system, making it much easier. Thanks for joining us tonight, and we'll see you soon.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.